Hey guys, Market Movers back with another video. Before we start, we've got a bit of news. We've got our first sponsorship, 35mm Vintage. They sponsored us with these very cool t-shirts. I'll give you that a spin. They're custom making t-shirts along with selling loads of really cool vintage clothes. They are online at 35mmvintage.com. They're on Instagram, 35mmvintage. They have a shop in Mayo, and they also have a stall at the Marina Market in Cork City every weekend for the rest of the month of October. And that leads us into today's video, which is the top 3 stocks to buy in October. Now luckily there's 2 of us, so that's 6 stocks that you will get to know about that we think you should buy in October. So
remember, this is not financial advice, and do your own research when looking into any of the stocks. Anything that we do mention here, make sure you do look at it yourself and don't just do something because we told you to do it.
And also, go check out our new competition. We're giving away €100 worth of cryptocurrency of your choice. So if you go into Instagram, you'll be able to share and enter the competition there. And also go follow us on Facebook, TikTok, and all our socials down below. And don't forget to join our free Discord. Now, after the longest intro we've ever done, let's get straight into the video.
Right, so the first stock that I'm picking that you should potentially be looking at now or looking to buy is actually Qualcomm. So you've probably heard of this before. It's a huge multinational company. They make lots of different chips for phones, especially like deals with Apple, Samsung, that kind of stuff. They run the Snapdragon processor. They've recently bought assisted driver company called Veneer that is based in Sweden for just over $4 billion, which is also bringing them into an entirely new space that they haven't been exposed to before. So it's definitely a stock to be watching based on the 5G movement, their new investment into automated driving, and the valuation of this company is absolutely crazy considering the amount of growth in lots of areas that they're exposed to. So like the PE ratio coming out with Qualcomm is only at 15. They have a forward PE of around 12, and like they are growing absolutely massively, like with growth rates at 52% for 2021 and 10% for next year, which I think is quite ludicrous because 5G is only starting to get going. So this is stock that is extremely undervalued considering the market currently now is trading the Nasdaq 100 at over 32 and the S&P 500 at 25. So it's trading well below the average of the market, so it's definitely one to consider if you're looking to get exposure to the chips and the 5G infrastructure, and now also bringing in a bit of automated driving too.
So guys, my first stock, which I spoke about before, is Wynn Resorts. So Wynn Resorts is a massive hotel chain based in Las Vegas, Macau, and Boston. They've got hotels, casinos, shopping malls, you name it, the biggest hotels. I've got a video, I'll link above that. I went deep into detail about what Wynn are about. Today we're just going to talk about their stock. They're beaten down at the moment, they're low. They had a bit of trouble with trying to control the gambling issues in Macau at the moment, which has brought their stock way down, but they're at only $86 a share at the moment. They are a $9.9 billion market cap. They've obviously had it rough with COVID. You know, they've been closed. Obviously tourism is way down. Macau is still shut down at the moment. But once Macau gets back up and running, they get over these issues, this stock I think is going to go absolutely through the roof. It is part of the S&P 500. It has been for a long time. It's got a massive chair. Their chairperson and their board is absolutely extremely experienced in this market. Their estimated revenue estimate growth is at 79.6% for this year and 46.6% for next year, which is absolutely huge. Even their next quarter is expected to be 58.7%. This stock is a money-making machine. Their company is a money-making machine. They have taken massive hits, and as soon as Macau is back up and running, Vegas is 100% back up and running. The Macau is the place to be when you're in these places.
My second stock is one that you've probably heard of as well, which is Alibaba. They run, obviously, Alibaba, the business-to-business enterprise system that's online. They also have AliExpress, and also they're involved in cloud computing and pretty much the exact mirror of Amazon, but are based in China. So this comes with its own risks. Like obviously we've talked about China a good few times on the channel, and like the situation that's over there, they can change things whenever they want, and they've basically gone after Alibaba, especially the CEO Jack Ma. He had a lot of issues with them last year. His Ant Group, that is also part of Alibaba, and they owe a lot of money in it, is also being penalized and potentially going to be taken apart by the Chinese government. So it comes with its risks. But Alibaba is an extremely well-run company. They're exposed to a lot of different areas. They're getting absolutely destroyed at the moment. It peaked at over $350. It's now down at $161, and that's just when it's had a good day. So it has been hovering in between the 140 to 150 range recently as well. And their growth rates are absolutely crazy, between 29 to 15% most of the time for the next few years. And it's just a stock that is extremely undervalued, and if it was in the US or it was in Europe, this stock would be valued an awful lot more than what it is right now. Like, so the trailing P is 19, a forward P is 15, and this is probably not too accurate because we don't exactly know what the whole situation there is, but it's definitely a stock that you should think about owning if you're wanting to take on a bit more risk from government controls or different laws that can come into place. But also you have to be aware, when you are buying Chinese stocks, you're not actually buying the Chinese share itself. You're buying like basically a share that's based in the Cayman Islands or the British Virgin Islands. Is basically just a shell share, so you don't technically actually own a share in Alibaba. So there's another risk that comes with this. So if you're looking for a bit of a high risk, high reward, Alibaba is definitely something to go for, and it's probably the best stock you can buy out of China as well.
So guys, my second stock is Facebook. So Facebook stock, it's an extremely safe play. You've got a forward PE of 20 and you've got a PEG ratio of 0.9. This is both below average, and the average forward PE for S&P is 25. So they're both below average. It's an extremely high value company in the sense of market cap. It's just under $1 trillion, 930 billion. It's had a bit of bad press recently, so it is down a little bit more than usual. It's at 330 per share. The Facebook is just such a huge company. It's always going to be around. You've got, when you're buying Facebook, you get Facebook. No, you get loads more than what I'm about to tell you, but the main ones: Facebook, Instagram, WhatsApp, and Oculus, which is a virtual reality system. So the Facebook is a company I think everyone should own. I think it's definitely a safe play, and I think at the moment it's at a pretty good buy price, and it's something I'm definitely putting my money into. Their earnings are going to be released on the 25th of this month, and I think they're going to be very, very good.
So it's run into a bit of a problems, Facebook stock, just recently in the last week or so. They've had a whistleblower that had the outage. Mark Zuckerberg lost over $8 billion or something in one day, but look, he made it back probably the next day.
Yeah, I don't think he's too upset about it.
Yeah, but it comes with its own risks too with Facebook, just people's perception of it. But
I don't think, whether people think it's bad or not, there's not enough people to think it's bad that it's ever going to matter for Facebook.
Everybody uses it.
Facebook's a giant. Everyone uses it. There's not a single person that is watching this video that doesn't use Facebook in one way or another. Yeah. So it's as simple as that. And as I always say, when you're buying stocks, buy the stuff you know. Buy what you know. Buy what you understand, and buy what you use, because you're the product at the end of the day.
When something's free.
Yeah.
You're not the product if you're buying the product.
No, but Facebook, you're the product.
Yeah. So my third stock, and the last stock that I'm going to think of, is something that I've previously owned before, but I've sold out of it. It's basically a stock that is used to take second-hand clothing, and you might have heard of it before if you're based in the US, maybe not so much if you're in Ireland, but it's the Real. So the Real is a stock that's been quite up and down. And the first time we ever looked at it, it was around $6 a share, and it went all the way up to around 29 to 30, and now it's hitting around the 11 to 12 mark. So this stock is quite volatile. It goes up and down quite a lot. It's one of the more riskier plays again, as they are a money losing company. They're not scheduled to make money within the next 12 months, and probably going to be another 12 months after that before they might actually see any profits on the board. So you have to consider how long can they continually to lose money before they will actually go bankrupt or they will survive as a business. So that's a risk that comes with this, but if they do survive, you've got a company that is sustainable clothing, high value products that they have. It's high net worth individuals that they're going to, and like the thing with sustainable clothing, it's going to be more and more in the press as green is becoming more of a thing. So it's something to consider as well. Like, it's pretty green. It's a green stock for in that kind of shape or form for the clothing market, and like their growth rates are absolutely crazy too. So this year it's coming in with a 49% growth rate, and the year after estimated of 31%. and like that slowdown is probably not going to continue. Like it's not going to go down from 30 down to 20. It's probably going to come in at about 25 growth rate for the year after, and like the valuation is not absolutely crazy either. Like, so these kind of stocks that are still losing money are generally based off like a price to sales. So price of sales, like you'd have some of these stocks that are extremely high growth, like Snowflake or something in tech space. They'd have a price of sales like of over 60, 70. Even one that we own, CrowdStrike, like they have a price of sales like of like 45. This stock has a really high growth rate, and it's got a good product, good website, and a good management team as well. And the price of sales of this is only 2.19. So when you're taking into consideration the growth rates, the price of sales, you're not really too looking at how much money they're losing or the forward PE that it currently has. So it's definitely one to consider if you're looking to take on a bit of risk, considering they are losing money and we don't know how long they can go with losing money pretty much. So it's a one to consider if you want to look at clothing and to expose yourself to a bit of risk as well, and the retail sector.
And on that topic, I also chose a clothing company to go with for my last stock. My one is probably more familiar to people that watch our videos at the moment, which is Farfetch, which are a UK based company. They don't go down the route of sustainable clothes and used clothes like the Real do, but they are just a top website for high-end fashion, luxury items, Louis Vuitton, Gucci, all that kind of stuff. You can even go as far as buying Rolexes on it. They supply pretty much everything. They've got an unbelievable app. Their app is absolutely fantastic, and their share price is at the moment at $37 a share. So like that's pretty low considering that their 52-week high is about 74, I think. So it's down at the moment. 52-week low 26, 52-week high 73, excuse me. And their price to sales, as Sam explained already, and their price to sales is 6.7. So like again, a pretty good company. If you look at their analysis, so there's 17 analysts on the stock, and they're expected to grow 39% in the next year and 26% in the year after. I do think the year after 26% is probably a little bit shy. It's a little bit low. Like fashion is an ever-growing, space, and also, not to mention, online fashion, being able to buy clothes online is just absolutely huge at the moment, which leads to our sponsors, 35mm Vintage. Make sure you go check that out. Their link will be in the bio below. They are also making custom-made t-shirts, as you can see here. They're excellent quality, and they're all sustainable and used clothes. So guys, that's Farfetch. So at the moment I have said Wynn Resorts, Facebook and Farfetch.
I said Qualcomm, Alibaba and the Real.
So guys, thank you very much. I hope you enjoyed that video. Make sure to do your own research. None of this is financial advice. Check out 35mm Vintage, our sponsor. Please hit the like button, hit the subscribe button, share this with your friends, and make sure to check out all our socials and join our free Discord.
And enter the competition that we just started.
€100 worth of any cryptocurrency of the winner's choice. So guys, thanks very much. Stay safe, and we'll see you in the next one.
Bye bye.